Welcome back to the channel. I'm overbought, and it's great to have you here for another deep dive into an automated trading strategy from MetaTrader 5. Today we're studying an expert advisor called the Stochastic Momentum Index Reversal. It's a counter-trend, mean reversion swing system built around William Blau's Stochastic Momentum Index, a smoother, zero-centered relative of the classic stochastic oscillator. Over the next few minutes, you'll learn how this indicator is constructed, how the strategy decides when to enter and exit, and how its risk controls work. Remember, this is educational information only and not financial advice. Let's get started. So what exactly does this expert advisor do? At its core, the Stochastic Momentum Index Reversal is designed to fade stretched moves. Rather than chasing a trend, it waits for price to become overextended in one direction and then looks for the first sign that momentum has turned back the other way. The engine behind it is the Stochastic Momentum Index, often shortened to the SMI, where a plain stochastic asks where price sits inside its recent range on a scale of 0 to 100. The SMI asks how far the close is from the center of that range, and then double smooths the result. This produces a line that swings roughly between -100 and +100, centered on 0. Because it is smoothed twice, the SMI is far less jittery than a raw stochastic, so its extreme readings tend to be more meaningful. This strategy is built for markets that tend to revert to a mean rather than trend relentlessly. The notes in the code suggest major currency pairs, such as Euro-dollar or Aussie dollar, or a metal, on the 15-minute through 1-hour timeframes, in a swing trading style. It is a patient approach. The strategy only holds one position at a time for each magic number, which keeps its risk exposure contained and the logic clean. Who might find this interesting from an educational standpoint? Traders who are curious about oscillator-based, counter-trend systems, and who want to understand how a double smooth momentum gauge can be combined with a signal line crossover to time entries. As always, no strategy avoids losing trades, and mean reversion systems in particular can struggle when a market trends strongly. Everything here is for learning purposes only, and never a promise of any particular outcome. Let's walk through the mechanics step by step. First, the strategy builds the Stochastic Momentum Index over a lookback window set by the SmiLength parameter, which defaults to 10 closed bars. It finds the highest high and the lowest low across that window, takes the midpoint of that range as the center, and measures how far the most recent close sits from that center. That sign distance, and the range itself, are then each smoothed twice using exponential moving averages of the smoothing period, which defaults to 3. The smooth distance is divided by half the smooth range and scaled by 100, giving the SMI value between roughly -100 and +100. A separate signal line is then calculated as an exponential moving average of the SMI, using the signal period, also 3 by default. Now for the entries. The strategy never fades an extreme on the extreme alone, because a market can stay pinned at an extreme while price keeps sliding. Instead, two conditions must line up on the same freshly closed bar. For a long, the SMI must be below the negative entry level, which defaults to 40, meaning it is deeply stretched to the downside, and at the same time the SMI must cross up through its signal line. That upward cross is the first evidence that the double smooth momentum has actually turned. For a short, the mirror applies. The SMI must be above the positive entry level, deeply stretched to the upside, and it must cross down through its signal line on that same bar. Once a condition is met, risk is scaled to volatility using the average true range. The stop loss is placed at the AT or stop multiple times the current AT or away from the entry, defaulting to 1.5 times ATR. The take profit is then set at the reward ratio multiplied by that stop distance, defaulting to 1.6. So the intended reward distance is larger than the risk distance. The strategy also checks that the spread is not wider than the max spread point setting before entering, and it holds only one position per magic number at a time, letting the stop and target manage the exit. Let's look at the actual MetaTrader 5 code driving this expert advisor. At the top you can see the input parameters. SmiLength sets the range lookback, defaulting to 10. Smoothing period, at 3, controls both stages of the double smoothing. Signal period, also 3, defines the signal line moving average. Entry level, at 40, sets how stretched the SMI must be. AtrStopMult stop multiple and reward ratio govern the volatility-based risk and max spread points. Lots and magic round out the settings. Just below, the code computes two Boolean flags. Crossed up is true when the previous SMI was at or below the previous signal, and the current SMI is now above the signal. Crossed down is the exact opposite. These capture the moment the momentum line ticks through its signal. Now the long block. The condition reads, if the SMI is below negative entry level, and crossed up is true. When that is satisfied, the code reads the current ask price as the entry, sets the stop loss one stop distance below it, sets the take profit at the reward ratio times the stop distance above it, and calls trade.buy with those levels. The short block is a mirror image. If the SMI is above positive entry level, and cross down is true, the code uses the current bid as the entry, places the stop loss one stop distance above it, sets the take profit the reward ratio times the stop distance below, and calls trade.sell. Both sides attach their stop and target the moment the order is opened, so the exit is defined from the very start. Now let's bring it all together on the chart. On top you can see the price candles, and in the panel below is the Stochastic Momentum Index in gold, together with its slower signal line in blue. Two dashed levels mark the extreme zones, one at positive 40 and one at negative 40. When the SMI pushes beyond either of these, the market is considered stretched. Watch the opening candles on the left. Price is sliding steadily lower, one candle after another, carving out a fresh low. As price falls, the gold SMI line dives down through the negative 40 level and into the lower shaded zone. This tells us the down move has become deeply stretched. But notice the strategy does nothing yet. A lone oversold reading is not enough, because price could keep sliding while the indicator stays pinned. Now look at the fifth candle. Price makes its lowest point, and then the SMI line, still down inside that lower zone, ticks upward and crosses back above its blue signal line. This is the exact condition the strategy has been waiting for. The momentum has visibly rolled over while still in the extreme. On this bar, the buy entry is signaled, marked here at the low. At the same moment, the stop loss is placed a set distance below, based on the average true range, and the take profit is projected above it at 1.6 times that stop distance. From here, price begins to recover. The next candles print higher highs and higher lows as the down move unwinds. The rally carries price up through the following bars until it reaches the projected take profit target, shown by the marker a few candles later. The long trade is complete, having faded the stretched decline once momentum turned. Now watch what happens next, because the mirror image sets up on the other side. Price keeps climbing, printing a run of strong candles into a fresh high. As it does, the gold SMI line surges up through the positive 40 level and into the upper shaded zone. The up move is now deeply stretched. Once again, the strategy waits. It does not sell simply because the indicator is high. Then, near the top of the move, the SMI line, still above positive 40, ticks downward and crosses back below its blue signal line. That is the short condition. Momentum has rolled over from the top, while still in the extreme zone. The sell entry is signaled here, marked at the high. The stop loss is placed a set distance above the entry, again scaled by the average true range, and the take profit is projected below it at the same 1.6 reward to risk distance. Price then turns lower. The candles roll over, printing lower highs and lower lows as the up move exhausts. The decline carries price down to the projected take profit target, shown by the final marker. The short trade is complete. So across this single illustration, you have seen both halves of the strategy. On the long side, price stretched to a low, the SMI dropped below negative 40, and only when it crossed up through its signal line inside that zone did the buy get signaled. On the short side, price stretched to a high, the SMI rose above positive 40, and only when it crossed down through its signal line inside that zone did the sell get signaled. In both cases, the double smoothing of the indicator is what makes those crossovers meaningful, and the volatility-based stop and target define the risk before the trade is ever placed. Remember, this is a simplified, illustrative example. Real markets are noisier, and not every setup resolves this cleanly. Losing trades are a normal part of any strategy. That brings us to the end of our breakdown of the Stochastic Momentum Index Reversal Expert Advisor. We've covered how the Stochastic Momentum Index is constructed, how the strategy waits for a stretched market and a same-bar signal line crossover before fading it, and how its stop-loss and take-profit are scaled to volatility. I hope this deep dive has helped you understand the thinking behind an oscillator-based, counter-trend approach. Everything shared here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. If you found this helpful, please consider liking the video, leaving a comment with your thoughts, and subscribing for more MetaTrader 5 strategy analyses. You can find more at www.overbought.live. Past performance does not guarantee future results. Trade responsibly.